joining in. All right. So the other day, I think we up until cost, volume, profit analysis, and did we do questions on limiting factor as well? I don't remember. If someone can just remind me, did we do a question based on limiting factor? Did I go through the tutorial? I think I went through the tutorial on limiting factor and linear programming. If someone can just remind me on that. I went through this, right? The steps on linear programming. Yes, I went through this. Shadow price, slack. Did it in this class, right? Yes. So today, if I'm right, we need to start from questions on pricing decisions. Okay, so before that, let's just roughly go through pricing decisions. And I have also got some doubts from students. I am well aware of that. I think I would have not got to reply to many of them, but either at the end of the class today or maybe by tonight, I will try my best to respond to all your doubts. So when you come to pricing, there are three approaches that we can use to price our products. Demand-based pricing, we can set our price based on the demand that our goods have. Cost-based pricing is where you calculate your cost and then you keep a markup on it and try to sell your product with a profit markup. Then you have market-based pricing. That is where you look at the market condition, the competitive environment, the kind of economy you're operating in, and then set your price. So when you're setting a price, you definitely have to check many aspects like how sensitive is your price how sensitive is demand to your price, what is the perception that customers have about your product, the quality of your product, how much are your competitors charging, what's the rate of inflation, how new is your product, what are the income levels of your customer or target consumer like, what's the product range you are selling, and are you setting an ethical price? So when you go to demand-based pricing, you generally consider price elasticity of demand. The demand equation is, sorry. I'm so sorry. Yeah, the demand equation is price equals A, that is price where demand is 0, minus B, that's the demand line, into Q. So how do you find B, which is the demand line? You find B by taking the change in price divided by change in quantity. It's like a gradient. And the optimum price or the optimum point in the demand line is where profit is maximized at the point where MR equals MC. How do you calculate MR? We know the price equation. The MR equation is simply, now this is A minus BQ. MR is A minus 2BQ. You equate this MR equation to MC and that will be the profit maximization point. If you want revenue maximization, you have to equate this to 0. So we'll see how that is used. Then you have cost-based pricing where you calculate your total cost, which is equal to fixed cost plus variable cost per unit into the number of units. And to your total cost, you add a markup percentage, right? To your total cost, you add a markup percentage and you get your selling price. So selling price per unit will be your total production cost plus total budgeted non-production cost plus your markup divided by the number of units sold. So these are all equations you have to remember. Return on investment pricing. These are prices that are set to achieve a target percentage return on capital. So you take your budgeted full cost and you see what is the target profit you want to make. That is your target ROI into the capital employed. You see how much profit you want. So therefore, your price should cover your full cost and that profit as well. And then you divide by budgeted sales units. Opportunity cost pricing is when you take the relevant cost of the project and add a markup to that. Life cycle costing is life cycle cost pricing is when you take the entire life cycle cost and you add a markup or margin to derive at a profit. Then market-based pricing, you have market skimming, where you start off with a very high price, especially if you have a unique product. And then after you enter the market, you gradually reduce your prices, especially when competitors are starting to come in. Penetration pricing is when you start with a very low price and then you start increasing. Complementary pricing is when you're selling two products together. You try to like probably price one at a, now when you take printers and cartridges, you printer is quite reasonable, but the cartridge is higher in price. So you complement the product range accordingly. Product line pricing, when you take Samsung, they have a few ranges of phones, the A series, the M series, the J series, the S series. So generally the S series I think is a little more expensive. The M series is like a more affordable one, or the A series is a very affordable one. So whatever is in that one line is like similar, like all the phones in the A series will be the same price. The ones in the S series will be a similar price. So it's like product line pricing. The products in one line have a similar pricing structure. Price discrimination is when for the same product from different customers, you charge different prices. Like airlines, they have divided their seats into three classes and they charge you according to the facilities provided. Relevant cost pricing is when you take only the relevant cost of a contract and you price based on that. Going rate pricing is when you just sell your products at the market price. Loss leader is when you're trying to sell a few products at very low prices to invite people in. And then after that, maybe you're selling other products at a profit and try to make that profit from elsewhere. So those are the different kinds of pricing. Let's take a question on pricing decisions. ALG course already done. TR course I have done. So I'm doing sculpt. Okay. Sculptco is a manufacturer. Sculptco is a manufacturer of electric goods. One electronic device it produces and sells is the GSA. There are between 30 to 50 other suppliers of similar but not identical devices in Sculptco's markets. Each producer enjoys varying levels of customer and brand loyalty. The current selling price for the GSA is 250 and Sculptco's directors are considering a reduction in price to 230. The market research commissioned by the company has suggested that the price elasticity of demand is 1.25. The same market research suggests that the price P, schedule and marginal revenue MR schedule for the GSA in its current market are as follows. So here they have given you the formulas. You don't have to find it. There may be situations where you have to find B. Then you take that change in price, divide by change in quantity to find B. A is the price where, or is when, okay, at a price of 0, what is the demand? So this is the demand when price is 0. That is 450. They have already given it to us. So they have given us the price equation and the MR equation. You can see MR is simply A minus 2B. B was 0.2. MR, here it's 2B. 0.2 into 2. 0.4. Production and selling costs for one GSA are as follows. Variable production cost, variable selling and distribution cost, fixed production cost, fixed selling and distribution cost. What's the marginal cost, guys, here? What's the marginal cost? What do you mean by marginal cost? Marginal cost is the extra cost of making one more unit. Sorry, guys. Sorry, I had to make this. Yeah, oh, no. What is the marginal cost? Do you take selling and distribution cost? That is what I'm asking you. What do you mean by marginal cost? Should we take the selling and distribution cost? For marginal cost, should we take the selling and distribution cost? Now, can you see here? They gave us profit maximization happens where MR equals MC. Now, MC is marginal cost. So, for marginal cost, do you take your selling and distribution cost? I'll just keep it to all right. Just keep thinking. Should we be taking it? Okay, let it be there. New customer order. A new customer order and variable production cost is a marginal cost. It's a cost of making one more unit, but I am just keeping it up to you. Is variable selling and distribution cost also coming onto marginal costing? You all keep thinking. New customer order. A new customer, LOK Co. has approached Sculpt Co. with a bespoke one-off order of 5,000 units of the GSA. The units will be produced in Salpco's factory along with all of its usual production and delivery to LOK Co. using Sculpco's and usual distribution channels. The order is considered bespoke as LOK Co. has requested some additional finishing in the production process, which will generate an extra production cost of $6 per unit. Okay, the units must also be delivered using a special packaging costing $2 per unit. The special packaging will be paid for and supplied by LOK Co. The variable production cost of the GSA includes the current purchase price of 7 per unit for an electronic chip. As the GSA is a popular product, the chips are in constant use and Sculpco has sufficient inventory of these chips to satisfy LOK Co's order. So you can see relevant costing coming here. The chips in inventory were purchased several months ago at a discounted rate of $5 each. A markup of 20% is usually added for all one-off orders. New market, Sculpco wants to sell to the country of Hairkish, which now allows the sale of the GSA. Following a change in its laws, Sculpco's objectives are to set a minimum acceptable price, which is most likely to discourage new entrants. So they want to set a very low price, and they think that by doing that, like a penetration price, new people or new suppliers will be reluctant to come into the market because they feel like they can't sell at that low a price. Shorten the initial period of the product life cycle in Hairkish to reach the growth and maturity stages quickly. They want to launch the product as fast as possible as well. Okay, now just come to it one by one. We have read the full case. There was so much detail, but a single question will generally be from one paragraph. Right, so you read everything, just keep in mind what it is, but when you're doing question at a time, you only think of that question and where you can get that answer from. Which of the following factors is least likely to be considered by Sculpco when setting its prices in its home market? What won't they consider when they are setting their price? Tell me to see. Which of these factors are they least likely to consider when setting their price in the home market? Shall we go with Amruti's answer? Currency in its home country. Could be because they're selling in their home market. Then, like, why would they need a currency? Least likely. Okay, we are going with that answer. Correct. Very good. Which of the following statements about the price elasticity of demand for GSA is true? Now, guys, now just go to that paragraph. They told you the price elasticity is 1.25. You guys tell me, is it inelastic or elastic demand? First, tell me that. Is it inelastic or elastic demand? 1.25. What is it? You all should be knowing that. Elastic demand, which means the percentage change in demand is greater than the percentage change in price. Now, keep that in mind. Now, read this. Which of the following statements about the PED of GSA is true? Its demand is price elastic and the revenue will increase if the price is decreased to 230. Its price inelastic. Yes. And if you reduce the price, will the revenue increase? Think of it. If the price is elastic and revenue will decrease if the price is decreased. The demand is inelastic. No, that is out of the option. These two are not the option because we already agreed it's elastic. These two say inelastic, so that's wrong. Now for inelastic, guys, if you reduce the price, demand will increase by a greater percentage, right? To reduce the price, demand will increase by a greater percentage. So generally, guys, what is the rule? For inelastic products like cigarettes, habit-forming goods, necessity like rice and all, what do you do to increase revenue? You increase price because you can increase price for that. But for elastic goods, to increase the revenue, what do? We reduce the price, right? So is Amruti's answer right? Only Amruti is answering. Very good, Amruti. A is right. If its demand is price elastic and the revenue will increase when the price is decreased. Because lower the price, the demand is increasing by a greater amount due to which the revenue will increase. Yes. What is the profit maximizing price for GSA? Oh, okay. So how do you now find profit maximizing price? It happens where, guys, marginal revenue equals marginal cost. Now we are given that marginal revenue is 450 minus 0.4 Q. Okay. What is the marginal cost, guys? So that we can first find the optimum quantity. Are you going with 30 or 54? What is the marginal cost? You all tell me, I'll go with your choice. You all are saying marginal cost is 30. Sure? Ram saying 54. What do I go with? Everyone answered to say I'll go with the majority. What's marginal cost here? First think of what is marginal cost. Marginal cost is the extra cost of making one more unit. I have 230s and 254s. What do I go with? The ones who are saying 54, why do you all say so? Marginal cost is the variable cost. Yes, but I'm asking you, should you take the, what do you say, no, this is production cost? No, this is non-production cost. So my question is, should we take only the production cost or also is it okay to take the non-production cost? Okay, let's take 54. Then now, if you take 54, what is your profit maximizing output? Oh, I got one more answer. Extra cost incurred per unit. Okay, I'm going to take 54. Let's see. So what is your profit maximizing quantity here? 396 divided by 0.4 Q. So optimum quantity equals 396 divided by 0.4. But they did not ask for the optimum quantity, no? They asked for the optimum price. So the optimum quantity is 990. Then at 990, what is the price? They are asking you, look at the question. What is the profit maximizing price? So the price equation is 450 minus 0.2 Q. So we can see now the optimum quantity is 990 according to this. So at that, so when the quantity is 990, what is the price? We have to find. At that quantity, price is 252. Correct. So guys, let's see here. P is maximized when marginal revenue equals marginal cost. In this question, variable cost can be substituted for MC. So you have to take, guys, remember carefully the total variable cost. It doesn't have to be only the production one. You take both together. Keep that in mind, right? It's a good question because it teaches you that as well. Next one. What is the minimum price per unit which could be set by Sculpco in respect of LOK's order of the GSA? Okay, now that is about this order. This order here. They're asking you what's the minimum price they should set for that order. Let's read that order again. A new customer LOK has approached Sculpco with a bespoke one-off order of 5,000 units of GSA. So this order is for 5,000 units of GSA. The units will be produced in Sculpco's factory along with all its usual production and delivered to LOK using Sculpco's usual distribution channels. The order is considered bespoke as LOK has requested some additional finishing in the production process, which will generate an extra production cost of 6 per unit. The units must also be delivered using a special packaging costing 2 per unit. The special packaging will be paid for and supplied by LOK. The special packaging will be paid for and supplied by LOK. So special packaging, they're asking what is the cost for Sculpco? No. Special packaging, LOK is paying, so we don't have to pocket that out. It's not a cash outflow for us. The units must also be delivered using a special packaging costing 2. The special packaging will be paid for and supplied by LOK. So for us, cash is not going on for that. So it's not a relevant cost for us. The variable production cost of GSA includes the current purchase price of 7. As the GSA is a popular product, the chips are in constant use. And Sculpco has sufficient inventory of these chips to satisfy LOK's order. That means they have readily available. So you have to go with the current purchase price. Wait. The variable production cost includes the current purchase price 7. As the GSA is a popular product, the chips are in constant use and they have sufficient inventory. The chips in inventory were purchased several months ago at a discounted rate. We don't take that. That is historical cost and is not relevant. A markup of 20% is added on all orders. So let's take variable production cost. We have to take it at the purchase cost. Variable production cost includes the purchase. The electronic chips we have to buy at. Electronic chips have to be bought at $7 per unit. We are buying for 5,000 units, right? Are they asking per unit, by the way? Price per, they're asking minimum price per unit. What is the minimum price per unit? So we can just take for per unit. We don't have to take for 5,000. This is 7 per unit. And then they said there's an additional finishing which generate extra cost. Then finishing has an extra cost of 6. Any other cost with this? Okay, variable production cost. Variable production cost, selling and those and all you have to anyways incur, right? Even for these, you'll have to incur them. So for this also, we'll have to incur the other variable production cost, right? We can take it like this. Let me show that. So how we take this is, yeah, we will have to take the normal cost. So what we do is, there is a variable production cost of 30. Now that 30 itself will be incurred. Variable selling cost also will be incurred. 24. But there is an additional cost of finishing 6. So that means total cost with this will be the normal cost and a 6 more. So the cost is 60. What is the minimum price per unit which would be set by Sculpco in respect of LOCO's order? Asking the lowest price they would charge. A minimum price meaning the future incremental cost. So the minimum price, the 20% markup should not be included in the calculation of a relevant cost. The markup, we don't generally take it because they're asking you what is the minimum price meaning the relevant cost, the lowest price. So they will charge at least 60. Markup and all, that is the extra that they will charge. The lowest they will charge is 60. So we take 60. Which two of the following pricing strategies are most appropriate for Sculpco in order to achieve its objectives in relation to selling the GSA in Yakish? What do they want to sell, by the way? They want to set a minimum acceptable price, which is most likely to discourage new entrants. So then you can't go with skimming, no. Sculpco wants to sell to the country of Hakish, which now allows the sale of GSA following a change in its law. So they want to set a minimum acceptable price, which is likely to discourage entrance, meaning they want to go with penetration pricing. Shorten the initial period of the product life cycle to reach the growth and maturity stage faster. They can also relevant cost pricing, yes, because they can charge a relevant cost. What do you guys think? I shorten, set a minimum acceptable price. So for that, they can check the relevant cost and see how much it is. Not transfer pricing, because transfer pricing is generally when you're transferring within your own departments. Price discrimination by product versions. It's just one product, right? The GSA. Complementary pricing. Does the GSA have anything complementary? I don't know. Do you all agree with my answers? Or are saying B? Market skimming? No, not market skimming. You can't charge a high price, no, when they want to discourage entrance. If they want to discourage entrance, why will they charge a high price? It can't be B. You all tell me what you all are going by. No, it's this. They say Sculpco wants to sell to a country of Harkesh, which now allows the sale of the GSA, following a change in its laws. They want to set a minimum acceptable price, not a maximum price. Minimum price meaning a price that is acceptable by all. And they are trying to discourage new entrants. If you set a very high price, the profit is high, right? So more people will get attracted. They want to discourage. So because of that, it can't be skimming. It's more likely to be penetration. What do you all say? And price C and D. We'll go by that. Yeah, it's C and D. I'll just tell you why the others are wrong. Market penetration involves setting an initially low price, and then, once the customers get okay with the product, you increase. Relevant costing would result in arriving at a minimum price as well. Even relevant costing is used to calculate a minimum price. So that is also likely to be the answer. Now, transfer pricing and all, here it's not selling between divisions, right? For the answer to be transfer pricing, there is no way. Right. So then after that, the next area is risk and uncertainty. Okay. This area, there's a high chance, there is a quite high chance you all can get it this time. But don't speak to me if you have not got, but there is a quite fair chance for you all to get this area this time, right? I have a feeling that you all might get it this time. So risk is when you know, like, okay, you know that, you have taken it, you have done something before, and therefore you have an idea about how things are going to happen. Not a full-on idea, but you have like you know that, okay, there is going to be like this percentage of a risk. You have some idea about what might happen. That is when you're taking a risk. Uncertainty is when you have no idea as to what is going to happen. You have completely uncertain, completely unsure about the situation the market is going to be in. Right? Three types of decision makers. You have three types of decision makers. Risk seekers, the guys who go and take the risk. Risk neutral, the ones who go with like, they don't want to take too much risk. No, are they too reserved? They're okay with taking a medium amount of risk. Risk averse is they really don't want to take any risk at all. So guys with a risk-seeking attitude, they go by max. They look for the maximum, the best outcome, and they go for it. Even if it's really risky, they don't mind. They just go for the highest outcome possible. Min guy, he looks at all the worst situations. Out of the worst situations, he picks the best. Minimax regret, he calculates the regret of each and every situation, and he picks the situation with the lowest regret. Expected value is someone with a risk neutral attitude. He goes by average profit, and he will select the profit where the average profit is the highest. So this is a payoff table. So this shows like different situations and, different, like, for example, these are the demands. These are the supplies. So you supply 40 and let's say demand turns out to be 40, you make 80. If you supply 40 and the demand turns out to be 60, you still make 80. If you supply 60 and the demand was 60, you make 120. But if you supplied 60 early in the morning, demand was only 40, meaning 20 you threw away. So you made a loss of minus 80. So this basically shows you like situations and the profits associated. How do you calculate regret? You look at the best situations, right? Meaning if the demand was 40, ideally, yeah, when the demand was 40 and supply was 40, you have no regret. If the demand was 50 and supply was 50, again, no regret, zero regret. Demand was 60, supply was 60, no regret. Demand 70, supply 70, no regret. Then what do you mean by the other things here? Now, if the demand was 40 and if you had supplied 50, see how much you regret by? Because now you're making zero. You could have made 80. So you're regretting by that 80 that you lost. If the demand was 60, if the demand, if you had supplied 60 and the demand was 40, you are making a loss of 80. So how much do you regret? This 80 you lost plus this 80 you could have gained. So your regret is 160. Like that, you have to calculate a regret table, right? You look at each situation horizontally, right? Let's get back. You look at each situation horizontally like this and pick the best situation for each demand level. If demand was 50, supplying 50 is highest. Demand was 60, supplying 60 was the best. Demand was 70, supplying 70 was the best. So now you look at it horizontally. When the demand was 40 and you supplied 50, you're regretting, oh no, I could have made 80 more if I made the right decision. If the demand was 40 and you supplied 60, you're regretting, oh no, I lost 80. So I'm regretting that 80 I lost. Plus I'm regretting another 80 I could have made. So you're regretting a total of 160, right? Now here, if the demand was 40 and you supplied 72 much more, you are making a loss of 160. So you're regretting, oh no, I lost 160. Not only that, if I had made the right decision to supply 40, I could have made a 80 more as well. So your total regret is 160 plus 80. So here you put the regret table like that. 160 plus 80, 240. So that way you have to do each and every line. Now here, this is zero regret. But if you had supplied here, it's a regret of 20. I'm making 80. In vain, if I made the right decision, I could have made a 20 more. Regretting 20 at this point. Here you're regretting 80. In vain, if I made the right decision, I could have made 100, 80 more. Here you're regretting 60 plus 100, 160. The 60 you lost plus another 100 you could have made. So that way you calculate your regret table horizontally. And then look at each and every regret. So if you supply 40, your biggest regret is 60. If you supplied 50, your biggest regret is 80. If you supplied 60, your biggest regret is this 160. Take the biggest regrets. Here 240. So out of the biggest regret, your regret is lowest when you supply 40. Sorry. Yeah, that is the lowest regret when you supply 40. Therefore, at the beginning of the day, you will decide to supply 40 if you are going by minimizing your regret. Whatever the situation, the regret is lower there. So you go by that. It's like a safe option to go by. So risk averse manager might even go by minimax regret. He will choose the situation where his regret is the lowest. A risk neutral manager will go by expected value, where you take it by outcome 1 into probability of outcome 1 plus outcome 2, probability of outcome 2, and then you total all out expected value. Guys, if they ask you this value of perfect information, how do you do it? You have to take the expected value with perfect information minus the expected value without perfect information. And see how much you are willing to pay for perfect information. I've done several questions of this sort in the class, and even in the Premier Plus recording, several questions of this have been done. Right? I'll do one today as well. Decision trees also, you all know, like you can use this to make decisions. Sensitivity analysis just measures how sensitive to one factor is to another. So sales price sensitivity, you take how much profit can fall how much sales can fall before profit becomes negative. Divide by total sales into 100. Variable cost sensitivity, required increase in variable cost to make the profit 0. Divide by total variable cost into 100. Sales volume sensitivity, decrease in the contribution. That means how much more can the contribution decrease by up to where your profit goes to 0. Meaning, if the contribution reduces by how much, will profit become 0? You have to take that amount. Generally, it is the profit figure that you take. Divide by total contribution into 100. Fixed cost sensitivity, required increase in the fixed cost. That is also again the profit figure. To make the profit 0, total divide by total fixed cost into 100. Stimulation, focus groups, market research is all used to find out about consumer needs and wants, and to try and reduce your uncertainty and risks to whatever extent you can. Generally, you use market research, you use focus groups to understand your market better so that your risk and uncertainty can be reduced to a certain extent. Let's take a question on risk and uncertainty. I have done this. There is table of regretness. I think I'm going to do this again. How do I take off the answers? Reset questions. Let's do it again. Okay. The managers of store hotel are trying to decide on their pricing strategy for the next financial year. Occupancy levels depend on the price charged. And the managers are trying to decide between charging 180, 200 and 220 per day. So these managers, generally, they use this tables when they're trying to decide, like, what do we do, right? And which option will give me, like, what profits and things like that. The different outcomes is what they're trying to look through that payoff table. So they're trying to charge a price between 180, 200 and 220. The variable cost of running the hotel are uncertain. They're really not sure about their cost that is going to be incurred. Due to fluctuation in the prices of food and energy, costs may be high, most likely, or low. The management accountant has produced a profit table, a payoff matrix, summarizing the possible levels of contribution for each price charged. So they have given you, okay, if the price is 180 and the variable cost was high, you will make 1339 contribution. If the client fee was 180, you charge 180, and the variable cost was low, you will make 1733. If the client fee was 220 and the variable cost was low, you will make 1575. Like that, all the different outcomes are given. The probabilities of variable cost levels occurring at high, most likely, and low levels are estimated to be 0.1, 0.6, and 0.3. Match the fee that should be chosen using a maxi-max and maxi-min decision rule. Let's do maxi-max first. Maxi-max guy looks at the best possible outcome. Now, when he charges 180, the best is 1733. When he charges 200, the best is 1706. When he charges 220, the best is 1575. Now, out of the best, what is the best contribution outcome? So you all tell me, what price will the max manager select? Which price when looking at it will give him the biggest return? 180 price. So that guy will select the price of 180. Maxim min. Now what will this guy look at? He looks at all the worst outcomes first. 180, this is the worst outcome. 200, this is the worst outcome. 220, this is the worst outcome. Out of the worst, what is the best? That is what he will see. Out of the worst, what is the best? So that is like a very safe option to go with. So if he picks a price of 200, and even if the worst happens, he will still make 1378. So he's happy to go with that. Like the worst outcome is lowest. So he will pick 200. Correct. Next one. What are the expected values of contribution for each pricing strategy? For each pricing strategy, they're asking you to find the expected value. Very simple. For each one, they ask you to find an expected value. So one expected values, 180 profit outcome. What is the price outcome? 180 price. What's the expected value? We can just do a quick working. They have told you low is probability most, wait, high is 0.1, most likely 0.6, low 0.3. So 1339 into 0.1 plus 1496 into 0.6 plus 1733 into 0.3. So that is the expected value for 180. For 200 price, the expected value is, so you're simply taking the outcome multiplied by that outcome's probability. 1738 is likely to happen 10% of the time because that is high, plus 1509 is likely to happen 60% of the time, plus 1706 is likely to happen 30% of the time. So that is the expected value for that. For this, it is 1313 is likely to happen 10% of the time, 1418 likely to happen 60% of the time, 1575 likely to happen 30% of the time. So what are the expected values? 151, 111, this one, no? B. Next one. The management accountant started to calculate a table of regrets, but did not complete it. The table is missing the regrets for the low level of variable cost. So low level of variable cost, only that one. For 180, 200, 220. So look at it horizontally. For low level, what is the best outcome? This is the best outcome for low level. So if the at low level, if your price is 180, you have no regret at all. At the low level, if your price was 180, no regret. But at the low level, if your price was 1706, if your price was 200, how much do you regret? You think, okay, in vain, if I charged 180, I could have made 1733, but now I made only 1706. So you're regretting how much? 27. Here you are regretting how much? If your price was 220, you feel like in vain. If I set the price at 180, I could have made a contribution of 1733, but now I'm only making a contribution of 1575. So you're regretting 158. So D. The managers of store hotel are risk seekers. They're going by taking risks. Which decision technique is appropriate? Risk seekers, it's max without a doubt. Okay. Identify by selecting the relevant box in the table below. You all tell me the answers. Whether each of the following statements regarding the use of expected values in decision making is correct or incorrect. They accurately reflect the risk associated with each decision. Are expected values reflecting accurately the risk associated with each decision? Are expected values taking risk into consideration? You all tell me. I'm waiting for answers. Can you all tell me what the answer for that is, right or wrong? Hello. Okay, I'll go with your answer. There are more appropriate for actions that will be repeated many times. Expected values is good for actions that will be taken many times. One more person reply to see. Look here. Expected values takes uncertainty into consideration as the probability of each outcome is taken and then used to calculate the expected values. So you are taking into account uncertainty when calculating expected values because you're taking the probabilities into consideration. The expected value is straightforward and relatively straightforward. Yeah. The actual expected value is a single number, meaning decision making is easier. It calculates the long-term average value. Expected value should not therefore be applied to one-off decision. When you're making a decision for only one time, expected value is not useful. Expected value is useful if you are making decisions again and again and again. If so, expected value is good. But if for a one-off decision, it's not good. Expected value may not equal any of the actual outcomes. Probabilities applied may be subjective. It can ignore the risk as a range of possible profit outcomes is not considered. It doesn't take risk into account. It may ignore risk, but it takes uncertainty into account. So now the first one, they accurately reflect the risk. You all said incorrect. They are more appropriate for actions that repeated more times. First answer this. They are more appropriate for actions that will be repeated many times. Correct. They may be unreliable as the probabilities used are estimates. They may be unreliable as the probabilities used are estimates. They are used by risk-neutral decision makers. Correct. Someone told me, Miss, can you do question 2 in the quiz, chapter 8? Okay, I'm going to go to that. What is that on? Quiz, chapter 8. Chapter 2 in the quiz, chapter 8. Which one? This one I'm just going to guess. Expect value, ignore the risk associated with decision making. Expected values are most useful for recurring rather than one-off events. You want me to do this? Expected value, they ignore risk, right? But they take into account uncertainty. Is this the one you want me to do, Afzal?
Yes, miss.
Right question, right? Okay. PT provides expert quality assurance services on a consultancy basis. The management of the company is unsure whether to price the services it offers at the deluxe, high, or a high standard or low fee level. There is uncertainty about the mix of staff that would be available to provide each of the services. As the staff are on different pay scales, the mix of staff would affect the variable cost of each service. The table below details the annual contributions earned from each of the possible outcomes. So if the staffing mix was X, these are the different profits. If it was Y, these are the different profits. And if it was Z, these are the different profits. If PT applies a minimax regret criterion, what fee level will it choose? So you have to do the entire regret table now. So let me do the regret table. You'll do one by one. We'll do X then, So, okay. If there was X staffing level, Y staffing, and Z, you have deluxe, high, standard, and low. So now if it was X, what is the best situation to be in? This. That's the highest. So if it was X and if you had got a high fee, there's zero regret. But if it was X and you had deluxe, you have to compare everything with the best now, right? So 140 minus 135, difference, you're regretting 5,000. Here 140 minus 137,500. Here 140 minus 120. Right. Then if it was Y, you have no regret here because that's the highest possible outcome. So when it was Y, if it was standard, zero regret. But if it was anything else, 165 minus 150, here you're regretting 15,000. Here you're regretting 5,000. And even here you're regretting 5,000. That is 165 minus 160. If it was EZ, no regret here. Zero regret. Everything else, there is a regret. So you do it horizontally like this. And then, so 200,000 minus 165. 200,000 minus 180. 200,000 minus 1925. Now you have to look at the highest regrets of each situation, each fee level. Here highest regret is, now look downwards, 35,000. If it was highest, if you had set a high fee level, highest regret could be 20,000. If you set a standard fee rate, your highest regret is 7.5. If you set a low fee rate, your highest regret is 20,000. So out of all the regrets, what is your lowest regret? Out of all the regrets, out of all the highest regrets, what is your lowest regret? This, right? Standard fee, you have the lowest regret. So you go by standard fee. I can't go back. Is that clear? Whose doubt was that, by the way? I'm just going to put random answers for this. Which of the following decision rule would suit a risk averse? Risk averse can go with either maxi min and minimax regret. So 2, 3. Here there's a sensitivity question. The cost card for product Tom is as follows. Expected demand for Tom is 10,000. What is the sensitivity of Tom to the nearest 0.1% to changes in demand? They're asking the demand sensitivity. How do you calculate demand sensitivity? How do you calculate demand sensitivity? Price, variable costs. We can go by the sales volume sensitivity, the demand, right? How much the sales reduction in sales volume will affect sales and variable costs. So that is how do you calculate sales volume sensitivity? Decrease in contribution. See how you calculate it. Decrease in contribution divide by total contribution into 100. Into 100. So your contribution can decrease by 30. Yeah. By 30. By 30. Before the profit becomes 0. So 30 divided by 80 into 100%. 37.5. First one, of course, I guessed. This one, these two I guessed, guys. This one is correct. Right? And even our last one is right. Whatever we did, we got it right. Once I guessed it, of course. They have done differently, but they got the same answer as me, right? What have they done differently? Same thing they have done, right? Isn't it the same thing? Oh, 5. I don't know. I use this equation set. Yeah, they have done it differently. I don't use that. Isn't it easy to use this equation? I have given a set of equations that you all can use. It's so easy to do this. Decrease in contribution, meaning how much can contribution decrease by before profit becomes 0. So basically, if contribution can reduce by another 30 more. When contribution reduces by 30, profit will become 0. So you have to see, generally you can just take this profit per unit amount. Divide by total contribution into 100. Don't have to do this way. You don't have to do it like this. They have taken the break even. Don't need to do that. You can simply do it this way. Just use those formulas. Or you can even, because sensitivity of demand meaning break margin of safety also can be calculated. I think they have calculated margin of safety. Even that can be done, no problem. Because especially it's for sensitivity of demand. So you can use margin of safety. Right. Any other, like some of you had sent me doubts, right? Any other doubts that you had sent me? I think I have not replied to those doubts. That's why I'm asking you. Any other doubts that you all want to clear? Can you all resend them? Yeah, this. If you all had sent doubts, can you all resend it? No, we are all okay. Okay, guys, make or buy decisions can come along with relevant costing. Generally, you will see this with relevant costing. So already I have gone through what is relevant costing. Make or buy decisions can be, should we outsource or not? Like, should we make in-house or buy from outside? So you have to compare the cost of outsourcing with the cost of buying in-house. Whatever is cheaper, sorry, cost of making with the cost of outsourcing, and you go with whatever is cheaper. Then they can ask yeah, you have to first say, do you have spare capacity? If you have spare capacity, you just compare the cost of making, variable cost of making with the buying price. If you don't have spare capacity, that means you have to take the contribution lost as well. Because in order to make this, you will have to stop something else. And the extra cost of making and compare with the buying price. Then they might talk about shutdown decisions. Do we close down or not? We generally look at the contribution lost. If by shutting down we are losing a greater contribution than the fixed cost we are saving, we should not close down. If we are losing a lesser contribution, but the fixed cost we save is great, it's a big cost we are saving, then we should just close the operations. Generally, we look at the contribution. If the contribution is negative, we shut down. If the contribution is positive, you keep it open, because at least it's little bit of contribution is coming towards the fixed cost. So at that point, if you close that division, you're going to make more losses. One-off contracts, definitely we look at the relevant cost. If the relevant cost is greater and the contract price is lesser, we decline the contract. If the relevant cost is lesser, but we are getting a greater price for it, we will accept the contract. Further processing decisions, we always look at what's the incremental revenue by further processing and compare to the incremental cost of further processing. If the incremental revenue of further processing is greater, you go ahead and further process. If the incremental cost is greater, then no point further processing. You sell it off at split off. Right? So those things will come with relevant costing. Any other questions you all want to clear? Like your doubt questions, someone, can you resend it? Some of you had sent doubt questions. So I would like to just, I don't know if the students have not joined these classes. I've always told you to join the classes to clear doubts. Who is this? Afzal, no, you only have sent me doubts. What is this question? You have sent budgeting. What is this? Sales price variance. Market size. Afzal, no. Afzal, you only have sent me some doubts. Miss, can you tell me how to do? What is this question you have sent, Afzal? Your doubt is, Miss, in market size, if budgeted sales is less. If budgeted sales is less, I think I explained this. No? Last Friday you asked me this. This one, now you have asked another question. Roboco I did, right? No? Okay, wait. First, Afzal, you have sent me one. What is this? Roboco make a cut though. Darshini, see part. What area is Roboco coming on? It's in Kaplan. Okay. Roboco. Is Roboco there here? Is Afzal? Afzal, aren't you there? You have sent me doubt. Where are you? You cleared your doubt by yourself. Flexing the budget means the expected revenue is 1.4. Actual sales is lesser. So it is adverse. What is the problem, Afzal? If the actual sales is lesser, it's adverse, no? I don't see what is your doubt here. So, this Altaf Sakaf. Altaf, have you joined today? Even you have sent me a doubt. Chapter quiz number 11. This guy's doubt is quiz number 11. Altaf Sakaf, you also sent me what quiz number it is. I'm just looking at the doubts. Question number 4. Which of the following ideal standards allow for? Which of the following do ideal standards allow for? None of the above. Ideal standards don't allow for any of this. The following statements have been made about flexed budgets. The flexed budget is prepared at the expected level. The flexed budget is used to identify variances caused at different levels. Flexed budget uses original budget assumptions in relation to selling price and cost per unit. I'm just going by. For which of the following activities would standard costing not be used? I'm just doing this just for whoever wants it, because instead of just doing, for which of the following would standard costing not be used? Valuing inventory, it can be used. Determining expenses for reporting to shareholders, you can use. Quoting for contracts, can use. Identifying opportunities for cost reduction. Quoting for contract and open cost reduction, we can use standard costing. What do you all go with for this? For which of the following would standard costing not be used? It's definitely used for valuing inventory. Identifying opportunities for cost reduction, also we can use standard costing. Quoting for contracts, quoting can use. Determining which expenses should be reported to shareholders. Let's go with that. Now, this is the question this guy had. Oveto Co budgeted to sell 100,000 units. The budgeted selling price was 1,410 units of the list were sold and sales revenue was 1,528,000 actual sales. Using a flex budgeted approach, what was the sales variance? So you are trying to see a flex budget. You're trying to flex this budget. That means your actual sales was, they have given 1,528,000. Budgeted to sell 100,000 units. The budgeted selling price was $14. So what is the flexed sales value? Actually, you sold 110,000 units. If you sold it at 14 each, your budgeted selling price was 14, right? If the actual units were sold for the budgeted selling price, what would your revenue be? 140,000, but the actual was lesser. By how much? By 12,000. So it's a sales price variance of adverse 12,000, because when the price changed, the actual price has been different. Oh wait, sales volume variance is not there. Sales volume variance 100, no, there is no sales volume variance. Volume, because you are using flex budget, the volume for this also 110, for this also 110. So volume no difference, but sales price has been different. That is why for flex budget, we are saying for the same volume, no. Now, this is also for 110,000. So, this is also for 110,000. So, there is no change in the volume, but there is a change in the price of 12,000 adverse. Did you get it, this boy, Afzal? Your doubt? Did I clear your doubt, Afzal? Afzal, did I clear your doubt? Afzal, did I clear your doubt on this question? The volume was the same. 110 only we looked for as well, for the other one as well. Normally, no, because they're asking flex budgeted approach, no. And normally, yeah, there is a difference in volume, budgeted and the actual. But they
If
are
they
saying
didn't
using a
ask,
flex
like,
budgeted approach. In the flex budget, we are taking for the actual volume. So therefore, there is no difference in the volume. Because the
if
flex
they
budget
didn't
is
say
flex for
flex,
that volume level.
there is,
Someone wait to ask me a doubt. What's your doubt?
means if they didn't say it's flexed, there is a volume variance, no?
Yeah, if they said it is not flex, if they asked to just use the budgeted figures, then there is a volume variance of 10,000. You are right. But when they say flex, we are taking for 110, no? So therefore, there is no volume variance. Is that clear? Good doubt. Anyone else? Someone else have sent me no doubt. Afzal has sent. Okay. I'm just clearing the doubts now. Huh? Afzal down clear. Then who is this student? Madam, can you explain what is the minimum revenue required for production to break even? What is the difference in this? They're asking the break even revenue. They're asking the break even revenue. I don't know who this student is. I'm just replying there in the chat. I'm just saying during the week who else sent me doubts, right? Because I want to clear your doubts that you have sent me on WhatsApp. Anyone else have I missed? No. Ahir Ram, Miss, can we do the naval question from the study hub in the next class? Neville question. Neville question meaning? What area is that Neville question from? Ram, you only have sent Neville question. What area is it from? I don't remember. I will do it, but let me see what area. I got it sorted. Now someone asked me Robert Co to do. CVP. I got it sorted. Guys, tomorrow I'm discussing the June pre-mock paper, right, in class. I will be coming tomorrow. How many of you coming to the institute tomorrow? Because I'm coming there to discuss that paper with you guys and just clear any more doubts that you all have. Coming now? Okay. After I come there, I hope you all are not you all are also present, right? So please come. Anybody else sending doubts? Now a student asked me, did you all do the mock? How much did you all score? Why, Raju? Come to the class. Come tomorrow because we are discussing the full paper, right? Only Ram is coming tomorrow. How much did you all score, guys? Your marks would have come, right? Didn't it come? Did you all get your mark? Mock was challenging. I thought it was very easy, that paper. I managed to do everything. Because I actually did the recording for it on yesterday or day before at the institute. Score didn't come. Okay. Right. So then after we have to do today, we'll be doing budgeting and control, just going through that. And we'll also be doing today quantitative aspects of budgeting. Then next class we'll be doing variances and the final chapter. Guys, I hope, yeah, it's prayer break now. Guys, I hope this you all remember. 24th, we are not having a class. I have rescheduled it, the TRG, to 31st and 1st. So 31st night you all will have, and 1st in the morning, or maybe around like 1:30 to 3:30, we will, 1:30, yeah, about 2 to 2, 3, 4, like 3 hours, right? 2 to 5. I'll inform that. I'll speak to the institute and inform you all the time of the extra class that will be on the 1st. That is because I'm not having on the 24th. I'm having it on the 1st, right? So 31st and 1st we'll be having the next TRG after today. Right. Now we are going for prayer break. 7:13. Come back at 7. Came back now. 30:35. Okay, Raju, if that is the case, then that's fine, right? I hope everyone's joined back. Right, let's go through budgetary control and budgeting and control. So you know that planning can happen at three levels of your organization. You can have operational day-to-day planning, which is short-term planning. Then you can have tactical, which is done by middle managers, and it's medium-term, like generally 1 year plans. And then there can be planning that's done by senior management at the strategic level, that is long-term planning. When you're planning for your business, you set your vision, mission, your objectives, like for the entire company as a whole, what is your objective? For different business units in individual terms, what are your objectives? You plan everything out. Then you set your mission and strategic objectives. So what is your mission? What's your objective, right? And then you plan your strategies as to how you're going to achieve them. So budgetary systems, when you're setting a budget, it's useful for your planning because you're kind of deciding what you want to achieve. Like the budget you want to achieve is like a target you want to achieve as well. And it is also a control measure. Why? Because your budgeted data can be compared with your actual results, and you can see how well you can compare your budgets to your actual performance, and you can see how well you did, where you went wrong, where you went right. Things like that can be controlled. And if you had gone wrong, you can understand where you went wrong and you can try to correct them and make sure it doesn't happen again. And then also budgets are useful for communicating, basically to let the others know about your plans, and also for performance assessment to assess how well you have done. When you are budgeting, you have to consider the ethical and sustainability considerations, very important in today's time. Now, there are different kinds of budgets. Rolling budgets are prepared in highly uncertain environments where you keep a budget for a set period of time always. So let's say you always want to have a 1 year's budget. If January of 2024 is over, you plan for 2005 January. So on a rolling basis. If February of 2004 is completed, you plan for February 2025. When one quarter ends, you plan for the other future quarter and make sure you always have a 1 year plan. Right? So like you delete the elapsed quarter off and you add one more quarter and you plan ahead. So always you have to keep planning on a month by month basis. But your plans are more likely to be very accurate because they are going to be up to date, but it's going to be very expensive and a tedious task to do a rolling budget. So incremental budgeting is very easy. You just take last year's budget and add an increment to this year based on inflation. It's very good for a stable environment. When you are operating in a stable environment, incremental budget is going to be perfect for you, right? Zero-based budgeting is generally done by government organizations where they want to be very careful of their funds because they have the people's fund with them, and they want to be very careful and make sure that whatever they're putting their money into is something that deserves to be put away, or is something that or something where the money should go in. So what they do is whenever they create a budget, they create it like as if it was happening for the first time. So they will define, okay, what are the different expenses? You have to tell them why it's needed, for what purpose it's needed, why I have included this much for advertising. Then they can question me, why have you put so much for advertising? Can't it be less? You have to be prepared to answer. So before they approve every single expense, they will evaluate individually every year. So every year you prepare a budget like as if it's happening for the first time. This is very time consuming, but generally used by the government sector. And sometimes companies, what they can do is once in 2 years, once in 3 years, they can do a zero-based budget. After that, they can use incremental budgeting. Like they might use a mixture of budgets as well. Zero-based budgeting is very expensive to do yearly, right? But generally governments, they do it yearly. Like they have a budget where they discuss in parliament and things like that, and they create a budget right from the beginning. Activity-based budgeting is where they calculate the activity like cost drivers, cost per driver, and they try to understand, okay, this is the cost for a driver, therefore let's reduce the number of drivers. They kind of try to budget using the drivers, right? So they're using activity cost drivers to try and manage their cost. Feed forward control is basically, here is it. Feed forward is like a proactive system. Before something happens, you try to identify and try to correct it. You can read through the advantages, disadvantages. Feedback is after something has happened, you try to give a feedback on it. Feed forward is more effective because you can identify things beforehand. This is you identify things after it has happened. So generally, you have a closed loop system. That is the standard is your budget. Your budget is set. You compare it with actual. The sensor will see whatever differences are there. So, okay, this is the standard. Then this is a comparer. That means this comparer will compare the standard with the sensor. Sensor is the actual. Sensor is the actual. Comparer will compare the standard with the actual, and there will be variances that come out. And according to them, that effector will take action. And finally, you make your output. Open loop system. Now see a closed loop system is a system with feedback. Here there is feedback. The effector is there. But here in an open loop system, there is no feedback. Feedback is not produced in an open loop system. Feed forward is basically, now this is your original budget. This is your forecast. Now if I'm moving in this, if my actual performance continues, this is my performance going to be. This is what my performance is going to be. But this is what I want my performance to be. This is what I want it to be. This is what it's going to be. So therefore, I will have to take control action to bring my performance up. So if I understand the difference between, okay, if I continue doing this, where will I reach and where do I want to reach? So basically, this is where you want to reach and this is where you are reaching. This is where what you're doing. So then you will have to take corrective actions to up your performance, to do better. So you can make rectifications if you identify where you are and compare it with where you want to be. So you take feed forward control, you take actions beforehand so that you can better your performance by the actual date. So you know what different kinds of budgets are there. Master budget is like the budget income statement, budgeted financial position, budgeted cash flow. They are master budgets. Functional budgets are when you prepare budget for each department like sales, marketing, labor budget. So there are budgets prepared for every business function. A fixed budget is fixed for a certain amount of output. A flexible budget can be flexed to different output levels. Then when you're setting budgets, if you allow employees to participate in budget setting, it's called participative budgets, but not all organizations allow it. Many organizations take a top-down approach where the senior managers set the budget and they just implement it on the junior guys. So you all will have to read these advantages, disadvantages on this. Bottom up budgeting is when you let everyone participate and it's a very lengthy and maybe sometimes if the workers are skilled, effective technique because it will increase motivation. Now in these two systems, there is no one right or wrong. The system you adapt will depend on the talents of your workers and the situation you are in. If your workers are skilled, you can use bottom up budgeting. But if you have unskilled workers, bottom up budgeting is not for you. Then you have to use top down budgeting. So there is no one right or wrong budgeting system. Whatever system you adapt will depend on your company and it will, if whether it's appropriate for you or not, will depend on your company as well. So there are different management styles that you can see. Budget constraint managers who are very much conscious about their budget and they always try to meet their budget. Profit conscious guys are just always thinking of making profit. Non-accounting style is where they try to seek for customer satisfaction and qualitative measures of success. So budget constraint guys and profit conscious guys, both are very much concerned about the cost. They want to keep it low as possible. But non-accounting guys, they're like, it's okay if price goes up or cost goes up as long as customers are satisfied. So their attitudes are different. These guys have very high tension, medium job related tension. Here again, medium. Manipulation of data can be very high here. These two little. Relationship with suppliers, they will have very poor relationships because they will always be pushing that supplier to sell at a low price. These guys might maintain good relationships. So you know that traditionally budgeting was done in a very like a what do you say, they just set targets and it was all about achieving that target. And like if you achieve the target, you were praised. If you will not achieve the target, you were, said that your performance was not good. So there were a lot of problems with traditional budgeting, so that now there's a system called beyond budgeting, meaning you don't set any hard and fast budget. You just set a few milestones you want someone to reach. But if the environment changes, you will be, your budget also, or your target or standard will also change with it. Now, for example, for exam students, they might tell us, okay, we want a 70% pass rate. But with beyond budgeting, they will not be very strict on it. What they will say is, we will see the actual exam. We will see the kind of students sitting. That means they will assess the situation. And according to this situation, was that 70% like something that we could achieve or not? So they will set a standard, but they are willing to change it according to the situation. Or after the situation happens, they might change their standard again. Now, if the exam was too hard and very like a weak set of students had the paper, then maybe it's understandable that a 50% pass rate would be okay. So beyond budgeting is not concentrating on setting one strict budget. They are allowing for the budget to slightly change or slightly to make variations to what is expected based on the actual situation. But traditional budgeting was not like that. They just set it and somehow you have to reach it. But that was very much a concept where you did not allow for environmental changes. But beyond budgeting is allowing for environmental changes. Right? You all can read through that as well and just understand about the traditional budgeting and beyond budgeting as well. So I'm just doing a revision. I'm just going through roughly. If I go to teach everything there, it will take forever. My focus is mainly to roughly go through the syllabus or the area and do questions. Questions are my main focus during TRG. But did you all get a recap on budgeting? Did you all just remember the important parts from what we went through? There's a C-part question. Budgeting can come in C-part. Did you all get a recap of what was done, by the way? Now, there's variances here. I'll do this question. You all have not done variances with your. Remind me to do this Nobel restaurant question after I do variances next week, right? Ram, remind me to do that Nobel restaurant question. It's a good question, but I have not yet done variances in TRG. So I'm not doing that. Guys, did you all remember budgeting with the recap we did? Or you all want me to explain any area in more detail? Because I roughly went through, that's why I'm asking. Guys, I'm asking you all a question. We can do this. There is variances, but it's not all based on that. Did recap of budgeting? What do you want me to explain beyond budgeting in more detail? What is it, Ram? When you say, what do you mean by? Okay, but what I said is simple. The beyond budgeting is that only. I think I already explained it. Basically, you are looking further than just budgeting. You are thinking of actual situations and what you are expecting from your workers. You are changing according to the situation. If the situation is tough, you will go down on what you are expecting. Like, for example, I'm giving now traditional budgeting. I will tell that guy, you have to sell 50,000 units. You have to. That is traditional budgeting. But beyond budgeting, what I will do is I will look at the situation. If there was a recession, if there was a lockdown, if there was like a curfew situation, if there was a flood, then I will reduce that. I will tell him, yeah, okay, this is what I budget, but based on the current situation, this is what you could have sold. So I'm changing his budget according to the situation. That is beyond budgeting. I'm not just looking at budgeting. I'm looking at actual situations. I'm looking at like customer satisfaction. Sometimes like I can't meet the budgeted cost because if I try to reduce the cost so much, my customers won't be satisfied. So beyond budgeting is not only looking at the cost. It's about looking at like more important things like customer satisfaction, actual situations, right? Employment, employee motivation levels. I'm looking at everything and then trying to decide what is the good performance in that situation. So that is beyond budget. You can just read the tute as well. What was I going to take? Exception. It's a good question, no? Yumiko, the following scenario relates to 3 requirements. These are section C question, guys. Okay. Yumiko owns a number of restaurants. It is a well-established company and its restaurants have gained a favorable reputation for the quality of their meals. Yumiko's restaurants are all set in rural locations where there is a limited competition, and this enabled them to develop a loyal customer base. Restaurants design their own menus and decor to fit with their requirements of the local market. Restaurant is making their menus to meet with the local market needs. Yumiko has been constantly profitable. However, as is the case across the restaurant, industry profit margins are quite low. Yumiko has been profitable, but the industry is not doing that well. And there's still a constant need for Yumiko to monitor their cost. One of Yumiko's restaurants is located in the small town of Kavli. Kavli has recently been the location for the filming of a popular television series, and visitor numbers to the town have increased significantly as a result of Yumiko's restaurant in Kavli has noticed a similar increase in customer numbers. Now, this restaurant is having good amount of customers coming in. At the start of the current month, a new restaurant opened in Kavli. Now, they're getting competition. The manager of Yumiko's restaurant in Kavli has expressed concerns about the impact of this new competitor. He's worried about this competitor coming in. Will have on the ability to achieve profit targets for the rest of the year. Budgets for all of Yumiko's restaurants are prepared by the head office. At the start of each year, restaurant managers are given an annual budget, which is split into months. At the end of each month, the manager receives a statement comparing actual monthly performance against budget. The statement for Cowley for the recent completed month is as follows. They budgeted 1,500 units. Actually, they sold 1,800 customers, more than their budget. They budgeted to sell 1,500 customers. Actually, they sold for 1,800 customers. So this is budgeted revenue, all costs and everything for 1,500 customers. Actual was for 1,008, meaning you can't compare these two. It's not like with like. This is a budget for 1,005. This is actual for 1,008. We need to flex the budget. We need to bring the flex budget for 1,800 units. Now, this is for 1,500, right? How can we compare it with 1,800 customer? It doesn't make sense. So, we have to flex the budget and get the flexed budget for 1,800 units. And that we will compare with actual. But they have not given. So, these variances are not meaningful. Rent rates and other overheads are apportioned to its restaurant by Yumiko's head office based on fixed annual charge. All other budgeted costs are treated as variable costs based on the expected number of customers. Only rent rate and other overhead is treated as a fixed cost. Others are all variable and it's directly related to the number of customers. Yumiko currently, 1 minute. Thank you, guys. Give me a moment. Right. UMICO currently adopts an incremental approach to budgeting with the annual budget figures for each year being based on the previous year's figures. However, a new finance director has recently joined the company and he has questioned whether this is suitable for all UMICO's restaurants. The new finance director has also suggested that the company should adopt a more participative approach to budgeting. Okay, the first question is asking you, prepare a flex budget for the Kavli restaurant. So they just want you to flex the budget. That is for 1,800 units. So revenue will be 75,000 for 1,500 units. That means how much for 1,800? Costs. Food and drinks is variable, directly related to output. Actually, food, drinks, staff wages, heat, light, power, right? Those are all directly related to volume. So 22,500 divided by 1,005 multiplied by 1,008. 31,500 divided by 1,005 multiplied by 1,008. 75 divided by 1,005 multiplied by 1,008. So I'm flexing it. Then rent, and other overhead, they have told you all other budgeted costs are treated as variable. Rent, and other overheads are apportioned to its restaurant by UMICO's head office based on an annual fixed charge. So that is fixed, no? So rent, and rate. Even for 8,005 or 1,800, it was budgeted to be 12,000. So based on this, your budgeted profit should have been for 1,008, you should have made a profit of 4,200. But actually, they have made 2,250. So it's not favorable. It's adverse. Because this was your budget for 1,005. And this is your actual for 1,008. Right? So this and this comparison cannot be made. With reference to your answer from part 1, explain the main weakness in the current monthly budget statement issued to the restaurant as a basis for managing performance. This is where I tell you theory questions can come. So I'm going to just read through the answers. So this is your flex budgeted statement. You can now compare this with actual, no? 1,008. And then you can get your variances. So you can compare that to the actual. 87,300. 26. These two can be compared with each other because it's like with like, same number of units. Now you can check your variances. So here, this minus this. Adverse. Cost, of course, you can take this minus this. So, profit is 1,950, adverse, not favorable. Now this, they're asking you to discuss the main weaknesses in the current budgeting system. So then you have to, like, first you have to take points from here. One main thing is their budget is for 1,005, actually is 1,008. So it is not like with like, comparison is all wrong there then, right? The most significant weakness in the current performance report is that the original budget is not flexed to adjust the actual number of customers served. It's a big limitation. The existing report shows that the restaurant has overspent on all its costs, which could be a concern given the importance of cost control in UMI. However, the main reason for the revenue and cost variance is that number of customers served was 20% higher than budget. So here we can see that all this has been like adverse. It looks like you have overspent at all points, but no, you have served 1,800 guys. So it's normal to overspend. So actually, when you go to see two places you have overspent, two places it has been, you have saved. Right? If the budget is flexed for the actual number of customers, this allows a more meaningful assessment of the restaurant's performance to be made. Once the flex budget is prepared, it can be seen that revenues were actually lower than what would have been expected. So for 1,800 customers, we should have expected 90,000 revenue, but it was only 87,000, meaning maybe we reduced the price. Maybe we gave like offers or something. Because for 1,800 customers, oh, this is not units, it's customers. We should have made a revenue of up to 90,000, but we only made revenue of 87,300. Maybe we gave the customer some discount, especially since the competitor guy came in. Right? Yeah, have been expected. Given the number of customers served with average spend per head being 48.50 instead of $50. Normally we charge $50 per head, but we have actually charged 48.5. How did we know that? Total revenue divided by the number of customers. Food and drink costs were also less than budget. Taken together with the reduction in average customer spending, this might suggest that some of the items on the menu had been changed since the budget was originally set. Another weakness in the Yumiko's budgetary control report is that staff cost, heat and light and power are presumed to be purely variable, dependent on the number of customers. Actually, no, the lighting may not be depending on the number of customers. Lighting may depend on kilowatt, right? So that method of allocation they have used may not be accurate. So even something like that you all can pinpoint. However, although the restaurant may recruit some temporary staff in busy period, it is likely that at least some of the staff will be permanent, meaning that it could be more appropriate to treat staff costs as semi-variable than variable. Yeah, not all your guys' staff are going to be on variable terms, right? You might have guys with salaries as well. So you could have taken it as semi-variable instead. Similarly, it seems like that there was significant fixed element with heat, light, and power. So treating these as wholly variable does not seem appropriate as well. Then they're asking you, discuss whether an incremental approach to budgeting is appropriate for Yumiko. Under an incremental budgeting approach, the current year's budget results are taken at the start point of preparing the next year's budget. So under incremental budgeting system, I'm trying to highlight it. Yeah. The budget is there. So under incremental budgeting, you take your last year's budget and you adjust it for any expected changes in this year, such as the impact of inflation, cost, price, sales growth, decline. You take your last year's figures and you make adjustments as to like inflation, different like common changes in prices that you observe. It's a very easy method. So you first introduce by saying what is incremental budgeting. The main advantage of the incremental approach is that it is very straightforward way of preparing a budget. So you start by talking about the advantages of this system. Appropriate for organizations which are operating in relatively stable environments. It's appropriate for companies in a stable environment. The location of Yumiko's restaurant away from significant competition suggests that the operating environment is relatively stable, meaning incremental budgeting may be appropriate for them because they have told them that they don't have that much competitors. Just now one guy is going to enter. Similarly, the fact that Yumiko appears to have a relatively well-established brand and customer base suggests that an incremental approach to budgeting for future revenues appears reasonable because it's more easy for them as well because they know that they have a very solid customer base. Even if it is difficult to identify some changes which need to be adjusted for in the next year's budget. However, one of the major disadvantages of incremental budgeting is that it does not provide any incentive to make operations more efficient or economical because you're always just thinking of increasing your budget, right? You're not trying to make things better. If the current year's figures are having slack, meaning if you're basing everything on last year's figures. So if last year's figures had any problems in that, you're carrying it forward for the next year as well. So if the last year had any slack and inefficiency, using them as the start point means that efficiency is automatically perpetuated into the next year as well. You're taking the past inefficiencies into the future as well. Such an approach seems somewhat inconsistent with the focus on cost control within Yumiko. If the company is worried about its relatively low margins, an approach to budgeting which challenges cost more critically, an approach of budgeting that looks deeply into every cost. Is it needed? Is it necessary? What are the costs that we can take off? What is the approach that does that? such as zero-based budgeting or ABC might be more suitable for helping to bring down the cost. Those two approaches are very good to bring costs down. For example, the highest cost is the staff cost, which could be analyzed, and Umiko could investigate making changes to its staffing model to reduce costs and improve efficiency. Problem with incremental budgeting is that they don't try to control the cost, they just take it forward. As mentioned in part A, whether labor cost and heat, light and power vary proportionately with the number of customers appears debatable. They are simply saying all the costs are varying with number of customers. I don't know if that basis makes sense also. It might not. If Yumiko's incremental approach ignore the relationship between the different activities and the costs, ultimately the budget will provide the management with little relevant information. Maybe ABC costing would have been more appropriate to divide the cost. This could become an increasingly important issue if competition in Yumiko's intensifies. Currently, they don't have competition, so maybe they can use. But if competition intensifies, they have to bring cost control into account. And for that, systems like zero-based ABC will be more appropriate, because incremental budgeting, if your methods in the past were wrong, even the future you're going to carry it forward. Define a participative approach to budgeting and explain the advantages and disadvantages of introducing this approach at Umiko. The current budget process is a centralized top-down process. They mentioned that, meaning that the managers from Umiko restaurant do not have an opportunity to influence the budgets in their restaurants. They don't have a say. By contrast, in a participative approach, each manager would be able to influence the figures for their restaurant rather than having budget targets imposed on them. Participative budgets, all managers are allowed to give their opinions and participate in the discussions. Involving the managers in the budgetary process should help to make the budget more effective and realistic, because they might know more about what is happening in their local environments. Local managers should have a greater understanding of the environmental factors and operational constraints which will influence the performance of the restaurant. The local manager knows about the local area better. So you're writing the advantages first, and then you will go to disadvantages. For example, and always remember, in this kind of question, take as much possible points from the case study. From the case itself, take the points. For example, the manager of Kauliko restaurant will have a better understanding of its customer. Talk about the case. That gives you a lot of marks. And the market conditions. So you have to relate to that case like what they are doing now. That manager will know, the Kavliko's managers will know more about the local market conditions, and they can provide greater insight into the potential impact of the new restaurant than a manager of the finance team at Yumiko's head office. Similarly, managers are more likely to be committed to achieving a budget if they have been involved. If those guys were involved in the budget, they also will be willing to put it to action more. Not least because their involvement in its preparation should help to ensure that they consider the budget figures to be realistic. However, because they believe that the budget was realistic, right? Since they have also given their input. So they feel like it's something that they can achieve. Rather than sometimes what the head office gives to them, they might have opinion about that by saying, no, it's too hard or something. But if they have participated in the setting of the budget, they are more likely to be willing to work towards it. However, involving the restaurant manager in the budgeting process is likely to make it more time consuming. For example, instead of running their restaurant, manager will have to spend time in the meetings with the head office staff, planning and preparing their budget. In this respect, it may be appropriate for Umiko to maintain the current top-down system, which are operated in a stable environment and where the insight from the local manager may not add that much value. But introduce a more participative approach for restaurants like Kavli, which are facing a period of change. Maybe for the restaurants, they have several restaurants, right? For the restaurants where there is no much change, they can just go with top down. But in areas where there is great amount of change, for those areas, maybe they can have participative style. So you don't have to have participative style for all the restaurants. You can have it for selected restaurants. Very good points. When you give points like that, it's very good. Another potential disadvantage of a participative budgeting system is that managers may try to influence the budget so that their targets can be easily achieved. There might be slack. A restaurant's performance compared to budget will then appear to improve. But this would actually be an illusion. They are purposely making their budget easy. One of the main issue Yumiko could face in this respect is that given the range of different location of its restaurant, it will be difficult for the head office staff to know whether individual managers are setting targets which are easy or challenging. They will not know the reality behind it also. If the restaurant were all similar in similar location, it would be easy to compare the figures. But when they're in different locations, it's not that easy to compare the figures. It's challenging. Similarly, managers are more likely to highlight issues which will lead to a reduction in their budget targets rather than ones which increase their target. For example, the manager at Cowley has highlighted that the new competitor will make it more difficult for them to achieve the budget. They're only putting the negative things out there so that the budget will be easy for them. However, the manager does not appear to have made a corresponding acknowledgement that the increased number of visitors to Cowley should support an increased revenue target. They did not put it forward because they want to like show that it was difficult, but we achieved something great. So they want to set the budget tough one and they want to show as if they perform better than that so that they can get bonus and there's a danger that the manager's participation in the budget could lead to the targets becoming less challenging. They might try to set an easy budget and their performance, they will try to show like it was greater than budget. But actually, maybe there was a favorable condition. They did not talk about it when the budget was set because they wanted to only make the head office like have an image like it's really hard for these guys to achieve stuff and they want them to reduce the targets so that end of the year when they achieve that and if they achieve a little more than that it looks as if that guy did something great but no it was because customers were coming in which in turn could affect Yumiko's competitiveness and profitability. So that problem is there when the managers are getting involved themselves. Right. So that kind of theory questions also you can expect in section C. Please study that kind of theory questions, how to answer, what method to follow. Right. When they say advantage, disadvantage, it's fairly easy, but don't forget to relate. Now, if you read that answer, how many times did they talk about the situation? They keep talking about Kavliko. Every single point they made sure they related it to Kavliko. That is what you should be doing. Talk as if you are in that situation. Talk as if you only know about this company. For this company, how is it an advantage? For this company, how is it a disadvantage? So with your knowledge, what you have studied, you have to relate it to that case. You're going to get half of your marks for that relating. Out of 10 marks, 6 marks is for relating to the case. So if you want to get the marks, relate to the case. All right. Okay. Then we go to quantitative aspects of budgeting. Wait, guys, I'll quickly drink some water. Quantitative aspects of budgeting. This is like, okay, when you are to prepare budgets, you all know, right? We need to do forecasting. We need to plan for the future. So when you're doing forecasting, you generally use like growth measures to increase sales. You can use high-low method. You can use time series analysis, where you identify a trend and then you make seasonal variations. You can make cyclic variations. You first have to identify the trend. Generally, you can use a moving average for that. And then you can try to adjust your seasonal variations and come to your final calculations. So you can use the additive or multiplicative model for that. Right? So you're trying to calculate your sales using a trend and adjusted seasonal variation. Then you can find correlations between two variables. You can use regression analysis to calculate A and B, which is in what you call fixed cost and variable cost. To find fixed cost and variable cost, you can use high-low method or you can even use regression analysis. Then you have learning curve. Like, what does it talk about? As you do a same task again and again, as you do a task repeatedly, you become better at it. The time taken, they have an assumption that says every time output doubles, the time taken, the average time taken reduces by constant percentage. So for learning curve, we have a few equations we learn. Y meaning the average time equals the time taken for the first unit multiplied by the cumulative number of units to the power B. What is B? B is the log R, the learning rate. If it's 90%, this becomes log 0.9. Divide by log 2. So this, remember, it will give you only the average time. If you want total time, you have to multiply by number of units. So what the learning rate assumes is that up to some point, the time taken will keep reducing. After a point, the worker becomes like he's at his maximum efficiency, and then he is making at that same time, he can't reduce more than that. He will make at that same low time continuously. So they always reach a steady state, right? Learning curve effect works best when the following factors are in place, right? If workers are able to learn and reduce their time taken, if these conditions are in place. A motivated workforce who are keen to work at a fast pace and keen to learn. The workers need to be motivated. They should be willing to learn. A low turnover of employees, laborers should not leave, because if they keep on leaving, again, whoever new guys come has to learn it from the beginning again. So you need to have a low labor turnover, meaning laborers should not leave. They should stay with you. The process should be repetitive, then only they will learn out of it. It should be labor intensive. That is when the learning will start. If it's machine can do it perfectly from the first time. But laborers, first time, they take a lot of time, but as they do it, slowly the time taken reduces. But you'll have to send me a message, right? I don't know if I can share it. Whatever area you need, you tell me. I'll not share everything. You just send me the areas you need. I'll send it to you, right? And it should be a new production process to the business. Because if the same process has been used, like it should be something new, then only you start learning, right? If you have been doing it for years, you already have learned. If it's a first time introduced, then only for the first product you take a long time. Second one, you slowly reduce your time slowly, right? So it should be something new, then only you will start learning of it from the beginning. So that is about the quantitative aspects of budgeting. I'll do questions with that. Analytical techniques. We'll do at least 2 questions. Big Chiako already done in class. Bokko also I have done in class. Hotel, I don't think I have done. Let's do this, right? I'll do 2 questions from this area. What is the sales revenue trend for year 2 winter? So I'll just go through, guys. I'll go through that again. When they ask for trend, how do you do it? Is it a 4-quarter moving average? What is sales revenue for the last 3 years is as follows. What is the sales revenue trend for the year 2 winter? Year 2 winter, they want the trend. This is the sales revenue for the last 3 years is as follows. What is the sales revenue trend for the year 2 winter? Okay, so if they have, now they're asking to find the trend. So you can find the trend using 3 ways. Line of best fit, pi equals a plus bx. For that, you can use either the linear regression or you can even calculate moving averages to find trend. So to find moving averages, what you do is, guys, you take, they will tell you what, now it's a 5-point moving average. You take 5 periods together, add together, divide by 5. Put it in the center. 5-point meaning, add these 5, take total, make sure it's in the center like Thursday. Then divide by 5. Then the next 5, 400 to 340. Take total, divide by 5. Like that you take it. Then you compare this average with this. Actually, when you this minus this, you will find the seasonal variation. This is the actual, this is the trend. Okay, this is the, see, this is Y actual sales equals trend plus the seasonal variation. Seasonal variation therefore equals Y minus T. So then you should take it like this. This is trend. No, by calculating moving average, you are finding the trend. Then to find the seasonal variation, 360 minus 398 minus 38. That means on this day, there is a seasonal variation of minus 38. Here 430 minus 400 plus 30. 470 minus 44 plus 66. Like that, you calculate the seasonal variation. To find the trend, you have to take the average. Huh? Then after that, if you want to calculate a day's trend, what you can do is calculate the average of the seasonal variations. That means like now Tuesdays, they are in 3 weeks, right? But the first Tuesday, there is no trend or anything because there was no moving average that came there. So for Tuesdays, you only had two. What is that here? 1 plus 30 plus 66 and some minus 77. You know, minus 67 and minus 77 if you take it in the correct line. Wednesday 2 were there, Thursday 3, Friday 2, Saturday 2. Then what you do is you add all this together. The totals of each day you take and add all together. It comes to minus 3.3. Then that minus 3.3 you have to again add. No, this is minus 3.3. No, you have to add it back to this. Then the total becomes 0. But the adjusted average trends for each day is given. The seasonal variation is found to be negative on Tuesday and Thursday and positive on Wednesday and Friday and Saturday. When forecasting into the future, the seasonal variation will be added to the forecast trend to account for the expected future seasonal variations. Here they are calculating the average seasonal variation. Now here is the daily seasonal variation. Now, if you want average seasonal variations, you take that day's total seasonal variations and divide by the number of events that are there. So this is the average seasonal variation if they ask you to find that. Now here, they're asking trend. Trend we generally find by taking the moving average. Problem is they have not told you 4-quarter or 2-quarter. They have not mentioned it. Is it a 4-quarter moving total? Is it a 5-quarter moving total? They have not mentioned it. To find the trend. Now, this is the actual sales. To find the trend, we have to take the moving average. Is it 2, 3, 4-quarter or 5-quarter? If it's not mentioned, generally you have to take 4-quarter if I'm right. Yes. They've taken, yeah, 4-quarter. They've taken the 4-quarter. If they haven't given you which, like whether it's 5-quarter or 4-quarter, you have to take 4-quarter moving total, right? So now let me put this here like this. To find the trend, you have to get the moving average. 4-quarter moving average. For that, you need the 4-quarter total. 4-quarter total. And then you divide by. And then 4-quarter average. Listen carefully how it's done. I'm doing this because it will be helpful for you all. So here. One moment. Guys. So year 2. I'm just putting this here so it's easy to make you understand what's done, right? They wanted in this question, they want you to find the sales revenue trend for year 2 winter. Year 2 winter. They want you to find the trend here, okay? Oh, there's a problem here. It's a 4-1, right? So we'll have to find an average for the average. Four-quarter moving, we have to find an average for the average because it won't come in the middle of anything, right? What happens is you'll have to find the average out of the average. So now these 4, we'll have to take one more blank. To make this small because all of you all are joining on the laptop, you all can see, right? Don't need to go that far. So now we take these 4. What's the total of this 4? 84, 72, 90, 104. Then you take the next 4. What is the total of that 4? That 4's total will come in the middle of that. The middle of that is here. Then you take this, the middle of this 4 is here, right? 90, 104, 88, 72. Then you take the next 4, which is this 4, right? Sorry. Then you take the next 4. So I'm taking the 4 averages. Then you take the next 4. Okay, now what you have to do is you have to add these 2 and take another average so that it will come in line with something else. So let's take the total of that and then we divide it by 2. So this is the 2 average for average, average of average. You know, take the average of an average in this case. This is the 4-quarter total. And then here you find the trend, right? Here you find the trend. This is the trend. Again. Oh, wait, sorry. I have not taken the 4-quarter total. I have not taken the 4-quarter average, no? I have to take a 4-quarter average. 4-quarter average. I have taken only the total, but average has to be found, right? I have taken totals, I have not taken the average. Total is there, where you take the total, divide by 4 to find the average. Total divide by 4, find the average. Now what we can do is, because we don't want to waste time, we don't have to do the entire table. They want this one's, no. They want the trend here. So to identify the trend there, we can just take that and divide by 2. To get the trend, they want the trend here, right? So for that, it will be this plus this total divide by 2. We can simply do like that. Why? Because they have only asked for that, right? So we don't have to spend all the time doing the entire table, right? Actually, even the 4-quarter average, we could have only found for these 2. So 94.5. Right? So see what they have done. They've only done that part, I think. They have not done the year 1 and not necessary. Like you can do the workings only for the areas that is needed. right? So trend you are taking by calculating a moving average. If it's 5 quarter, it's very easy because it comes to a middle. You don't have to calculate average of average. But if it is 4 quarter, you have to calculate average for the average as well. So it takes more time. The seasonal variation for summer has been calculated as minus 20.22. For all the summers, there's a seasonal variation of minus 20.22. Using the additive model, the trend figure for year 3 summer has been 98.5. Year 3 summer. Year 3 summer, they have given us 98.5 is the trend. We don't know, but they have given it to us. The trend figure for year 3 summer has been 98.5. So they have given that. What is the deseasonalized sales revenue? That means they ask you to remove the seasonal effect. What is the seasonal variation? Minus 20.22. How to deseasonalize it? That means you have to take the seasonalized adjusted data. From subtract positive, for additive model, subtract the positive variation from the actual data to deseasonalize and add the negative variations. So they are asking seasonal effect is minus 20.22. So this is after seasonal, no. 98.5 is after the seasonal effect. So before the seasonal effect, what was it? You have to add it back. So trend 98.5, but there was a seasonal fall of 20.22. So that means without the seasonal effect, how much is it? 118. I taken the correct one. What is the deseasonalized sales revenue for year 3 summer? This. The trend figure has been 98.5. The seasonal variation for summer has been calculated as 20.22. Seasonally adjusted data, actual data that has been stripped of seasonal variations can be used to explore the trend. When actual data is given and seasonally adjusted figures are required, subtract positive variations from actual data and add variations to actual data, negative variations. Wait, when actual data is given and seasonally adjusted figures are required. So if they have given you the actual and they're asking for seasonally adjusted. Now in this case, they have given you seasonally adjusted and they want you to work towards finding out the deseasonalized, right? So then I don't know why I'm not getting the answer. Are these a different set of figures? Same thing, right? Hotel sales revenue for the last 3 years are as follows. Seasonal variation for summer has been calculated as 20.22 using the additive model. The trend figure for year 3 summer has been calculated as 98.5. Let's see. Deseasonalized figure equals actual minus the seasonal variation. Isn't that what I did? What I did was I took the trend. We are not supposed to work with the trend here. They have told, when actual data is given, okay, for the actual data, you have to add the negative variations to actual data. So you have to take the actual. For year 3 summer, the actual is 76. So how you work around this is to get the deseasonalized figure. You start with not the trend, you take the actual. See, when the note, it's clear. For deseasonalized figure, just look at my note. I'm sorry, it's my mistake. You have to take the actual. When actual is given, so you start with the actual and you add any negative variations. Negative variations. So what you do is, they have given a negative variation here. So actual for this is 76. To that you add 20.22. So you don't take the trend, you take the actual figure and do the variation. Right? So be careful there. Assume the trend can be described by the equation. Now they have given you a trend equation as y equals 77.33 plus 2.46x, where x is the quarters, number of the quarter. And year one spring is expressed as 1. This means year one spring. Year one spring has a quarter number of 1. So that means here quarter number 2, here quarter number 3, here quarter number 4, here quarter number 5, 6, 7, here 8, here 9, here 10, 11, 12. The seasonal variation for winter has been 18.16. First, we have to find the trend before we adjust that. What would be the expected sales revenue for year 4 winter? Year 4 winter. Oh. Year 4 winter will be, what is the number for year 4 winter? Year 4 spring 13, year 4 summer 14, year 4 year 4 spring 13, year 4 summer 14, year 4 autumn 15, year 4 winter is how much then? Year 4 winter will be, number will be what, 16, no? So we have to take x equals 16. So year 4 winter, x is equal to 16. So when x is equal to 16, what is the trend? We have to find that first. Now for that, we have to adjust the seasonal variation. In winter, there is plus 18.16. $134.85. Then here, identify by selecting the relevant box in the table below whether each of the following statement about time series analysis is correct or incorrect. Time series analysis assumes that all movement in actual figures can be completely explained by the trend, seasonal variation, and cyclic variations. Correct or incorrect? All the changes in actual data can be, or actual sales will be explained by the normal trend, seasonal variation, and cyclic variation. Is that right? Is random also, you're right. Okay. I'll just go through this. It enables future predictions as compared to ILO method. It doesn't only rely on one point, it relies on more points. Analyzing data into component parts. You're not only looking at trend, you're looking at many more aspects. But data must be ordered over time. You have to get a lot of data and collect a lot of data for this. That's a problem. The reliability of a forecast depends on the amount of data on which the trend seasonal variations are based. If you are using less data, it's less reliable. Due to loss of data, calculating moving averages, data needs to be collected over a long period. Random factors may also influence these calculations. Especially if there is random non-recurring events, it can affect the actual sales. And exploration deeper into the future might be inappropriate as well. So actually what happens with time series is we look at 4 factors. Our sales can be affected by 4 things. Here, trend, seasonal variation, the total sales can be equal to trend plus seasonal variation plus cyclic plus any random factors as well. So this could be incorrect because they have not included random variables. The further into the future forecast, the more reliable they are. No, it's not reliable. The seasonal variation using the additive model will always sum up to 0. Yes, if you want the note, here you go. Seasonal variations using the additive model will always equal to 0, guys. Additive. The seasonal variations using the additive model will always come to zero. It should come to zero. You have to do it till that. The seasonal variation using multiplicative model should come to zero. No, there is nothing like that. No? Multiplicative model. It doesn't come to zero. It's just like a average of y. We corrected wherever we went wrong. So that was a question on like time series moving averages. Practice more questions on that part. I think I'm going to make a small change to my note as well. Here. Where's that seasonally adjusted? Yeah. So this is actual to get deseasonalized, sales. You also can note this down, equals actual sales minus, no, add negative variation. Or if you're taking positive minus positive variations. I don't know if you will take it as divided, no? So I'm going to put in another line. Or actual sales minus positive variations. Multiplicative model. Divide actual data by the seasonal variation factor. Here, actual sales to get deseasonalized. You take the actual sales and divide by the seasonal variation factor. Don't take the trend, guys. Take the actual sales. They ask for deseasonalized sales, right? So I've just adjusted my tute also there. Then I want to do one on learning curve. Next week, or not next week, we won't be having Friday. We'll be having Friday after that. I think I informed that. It won't be on the 24th. It will be 31st and 1st. So 31st, we are going to be doing all variances, advanced variances, those things. First, we are going to be doing the last few chapters, right? That we have not done yet. So that is the plan. Now let's do one question on learning curve. I don't know if we have done my code. Yes, analytical techniques can come for section C. Well, I'm thinking whether to do this today or next class, because I have a class after this as well. So I'm wondering whether I can finish this by 9. Okay, we'll do it. Micro produces microphones for mobile phones and operates a standard costing system. Before production commenced, the standard labor time per batch for its latest microphone was estimated to be 200 hours. The standard labor cost per hour is $12 and resource allocation and cost data were therefore initially prepared on this basis. Production of the microphone started in July and the number of batches assembled and sold each month was as follows. July, August, September, October, November, they have given you the batches that were made and sold. The first batch took 200 hours to make. So that is A, time taken to make the first unit. As anticipated, but during the first 4 months of production, a learning effect of 88% was observed, although this finished at the end of October. So learning effect is applied whenever the output doubles. The learning formula is shown on the formula sheet, and at 88% learning, the value of B was minus 0.1844. Myco uses cost plus pricing to establish selling price for all its products. Sales of its new microphone in the first 5 months have been disappointing. The sales manager has blamed the production department for getting the labor cost so wrong, as this in turn caused the price to be too high. So probably they took the time taken to make the first unit as the time for all other units. But actually time taken would have dropped. When time taken drops, labor cost also drops. But maybe they did not take it into consideration. The production manager has disclaimed all responsibility, saying that as usual, the managing director prepared the budget alone and didn't consult me. And had he bothered to do so, I would have told him that a learning effect was expected. Calculate the actual total monthly labor cost for producing the microphone for each of the 5 months of July and to October. Okay. They're asking actual labor cost, right? What is the labor cost per hour? Oh, 12 per hour. Okay. So in July, they made only one batch. The first batch took 200 hours to make. So July, guys, let me put this format. In July, they made only one batch. One batch. And in July, it was their first batch, no? So they took hours taken was 200 hours. Now, in August, again, they made one batch. But there was a learning effect. But output was not doubled in August. But still, there is a learning effect in August. Number of batches assembled and sold. August, they made only one. Okay. So in July, they made one batch. So in August, July and August together, they would have made two batches, right? We have to take the cumulative batches. July, one batch. In August, now here, they would have made 1 plus 1, 2 batches altogether. Okay. So that means the output has doubled. The total output has doubled. From 1, now they have made 2. So every time output doubles, there is a learning rate. What is the learning effect? 88% learning effect. So actually here, because it has directly doubled, we can simply take it like 200 into 0.88. 176 hours. We can use that first method. Every time output doubles, the learning rate applies. It goes from 1 to 2, the learning rate applies. Then in September, they have made another 2. That means total output is 4. So again, output has doubled, meaning again we can, this is the average time. This is not total time, this is the average time. What is the rule? I'll just put it here. Every time output doubles, the average time goes down by the learning rate. So now again from 2 to 4, output has doubled. So again, the learning rate will apply on the average time, not the total time. So then in October, 4, that means 8 batches. Again, that output average time will apply. How much is it? 136,294. What are they asking you? Calculate for each of the 5 months. November also, no? But they said the learning formula is shown on the formula sheet. What did they say here? Although this finished at the end of October, that means after October, there will not be any learning. So after October, there will not be any learning. That means the average time after October will not change. It will be the same. So in November, it will not go down. In November, they made 8 units, meaning altogether 16. But for this 16, the average time will be 136.294 itself. Basically, the average time will be the same. It won't change. Because there is no going to be no learning. October to November, no learning. So now let's take the total time. So here for 1 hour, 200 hours. Here 2 hours, no? So 176 into 2, 342, 52 hours. Then here 1488 into 4, 619.52 hours. Now we're taking the total hours. So that is your total time. But I think they're asking the monthly, no? So we have to take total time per month. These are total times. These are total times per batch. Yeah. Now let's take the total time for the items made in that month. Can say total monthly time. No? So in this month now only one was made. No, so 1 into 200, 200. In this month, average is 176. That means for one batch 176. In that month only one batch was made. Yeah, average is 154, but in that month actually 2 were made. This is the total time for that month. Now they're asking the payment for that month. No, so we can multiply by 12 and take it. The payment for that month can be multiplied by 12 and taken. They're asking only for August, no, right? They're asking the labor cost per month, right? They're not asking only for August. Okay, actually, what we can do is without doing this, we can simply do this. No, this 116 points minus this. So the increase in time, increase in total time will be the addition in that month, right? Have I taken this multiplication? They have taken the learning rate for November as well, but they mentioned that November the learning doesn't happen. The learning formula, a learning where 88% was observed, although this finished at the end of October. They have taken the learning rate for that month as well. Or have they given you October sales? November sales. Oh, okay. What has happened is during the first 4 months of production and learning, 88% was observed. Although this finished at October. That means the last batch of October, the learning rate ended. The last job batch that was made in October, the learning rate ended. So that is the which batch? The 7th batch. The time taken for the 8th batch, the time taken for the 8th batch, right? Yes. Will be the time taken for all other batches after that. So we have to find the time taken for the 8th batch because learning stops at the 8th batch, right? So how to find the time taken for the 8th batch? We can take the average time for the 8th batch. How to find that? Time taken for first, we have to find the average time. Basically, we have to take the total time for 8 batches and we have to subtract the total time for 7 batches, right? So we can't find total time because we don't have any formula for that. So generally we use the average time formula. Y equals A, x to the power B. So average time for 8 batches will be time taken for first batch 200 into 8 to the power minus 0.1844. Can someone please, I'll just take the value from here. Average time for 8 batches is, can someone tell me the answer that comes here? What's the answer that you'll get here? Average time for 8 batches. So what's the total time for 8 batches? This into 8. Then average time for 7 batches. So total time for 7 batches will be average time into 7. So time taken for the 8th batch is time taken for the 8th batch is 112 point 778. Yes. Time for the 8th batch is 112.501. Correct. So time taken for 8th batch is 112.5165168. Okay. So total time from 8 to 16 will be, that is the 9th batch to 16th batch, total time will be it's going to take like every batch. That means for the 9th batch to the 16th batch, there's 9, 10, 11, 12, 13, 14, 15, 16. There are 8 batches. For those 8 batches, you're going to be taking total time of 900.1321, that amount, right? For this, there's 112.5165168. It's from the ninth batch onwards. Ninth, 10th, 11th, 12th, 13th, 14th, 15th, 16th. So 8 batches. This is the total time you're going to be taking. Meaning average time will be that divided by 8, right? Wait. Yeah. No, you don't have to take that figure. This is enough to calculate the monthly salary. So these are the times for those months. Now to get the total wage, simply take this multiply by 12. So you get the total wages. 2,400. Yeah, you get the total wages. There's like a point difference. What happened? You get the total wages that way. So for that, you have to find mainly in this place because they say that the learning effect stops. In this place, they mentioned that the learning effect stops in October, meaning the last batch that was made, the 8th batch. Time taken for the 8th batch was the time taken for all other batches after that, right? So for these 8 batches that were made here, that's a 9, 10, 11, 12, 13, 14, 15, 16. The 8 batches made there, you took in average 112.51. So in total 900. Right now, for these we have found, right? The times taken in those months. So here, those amounts we have found. Took the extras, right? Total incremental hours we took. So here the total time would have been this plus this. The average time here would be this divided by 8. Because here altogether we are seeing the total time here. Here is only the extra timings, right? So extra timing for that incremental time. For the incremental hours only, we are calculating the wage rate. Guys, you all can copy this down because it's a fairly tough question to do. It can be copied down, the answers. Mike, take a picture of it at least. So when you all are doing it, please redo this. It will be easier for you. Please redo it. Copy it down or take a picture of it. I'm not doing the other parts of it. Only this part because it's fairly tough. You all can take it down. So these are the wages, however, the monthly wages that they're asking. How did we get this? We took the incremental hours and multiplied by 12. So here, the time taken for the 8th batch was the time taken for all other batches after it. That's for the 9th to the 16th batch. So make it note of that, right? 112.5165168 into that 8 batches. So 900.1321344 hours in November. Mark that. Please make a note of it. It's a good question that we did there. Take a picture of it because there won't be recordings of these. So take a picture, guys, now before I end the class. Many students have already left because it was too difficult. The ones who are here, you all understood the final answers here. Anything still confusing you all in this question? Please take it down, right? Anything still confusing you all can ask me. They have asked the total labor cost, so it will depend on the total hours, right? Okay, guys. So we'll stop there. I'll meet you again on the 31st, right? So these are fairly tough questions which you should be practicing. The others I'll meet